DraftKings stocks, ticker symbol DKNG, was up 7% this week after it released its earnings, and we're going to talk about why. We're going to talk about why it rallied into and after its earnings print, and we're going to talk about, is it a buy right now? But before we dive in, if you could please go ahead, like and subscribe. It really helps me out. Now, DraftKings reported very mixed earnings right here. You can see they beat on EPS estimates but missed the revenue target, still growing 20% on a year-over-year basis, reporting $1.4 billion in revenue and EPS of -7 cents. So this company is still a loss-making business. At the same time as mixed earnings results, the company actually lowered its revenue and EBITDA guide. The company said it now expects $6.2 to $6.4 billion in revenue for the full year 2025. This was actually down from the $6.3 to $6.5 billion target. And then the EBITDA guide is now $800 to $900 million. Previously, it was $900 to $1 billion. So missed on revenue, lowered guidance, not very pretty earnings when you look at the headlines. However, diving into the financials, there was some good things. Gross margins actually increased on a year-over-year basis. That really goes to show their competitive edge. And we did see EBITDA as a whole improve drastically. EBITDA in the same quarter last year was -6.1%. We are now actually in positive. Earnings before interest, tax, depreciation, and amortization. And on a net dollar figure, the company actually reported $23.7 million, up from a -$71 million range in the same quarter last year. However, free cash flow went in the opposite directions. We saw -6.5% to -8.6% in margin, and then net dollar value actually fell from -$73 million to -$121 million. And this had to do with some of the acquisitions that were made in this quarter. The company still has $1.1 billion worth of cash, $1.9 billion worth of debt, so the balance sheet fairly healthy. EBITDA looking good, free cash flow not that great. However, again, it had to do with capital expenditures and acquisition costs. So if revenue missed, guidance was revised lower, and free cash flow went the wrong way, why was the stock up 7% over the last 5 days? And if you dive into the conference call, you could definitely understand why. Management came out and said if it was not for customer-friendly outcomes in March, they would be raising their full year 2025 revenue and adjusted EBITDA guidance. Customer-friendly outcomes means they just had to pay a little bit more in jackpots. Furthermore, when you actually look at the overall underlying fundamentals of the business, things are actually rather good. You see, this quarter, the company actually acquired this company called Jackpocket. And because of that, average revenue per user was $108 in the first quarter, which is actually a 5% decrease, right? However, if you actually exclude this acquisition, ARPMUP, or average revenue per monthly active unique player, grew 7%, and that's very solid considering the macro environment we're in. Monthly unique players actually increased 4.3 million. This was a 28% increase, and you can see that DraftKings Sportsbook and iGaming products are now officially in Canada, which represents 40% of Canada's population. So potentially we're looking at a guidance raise, 28% increase in payers, and a 7% increase in average revenue per payer. That is why the stock was up, because the underlying fundamentals of the company continue to improve, especially when you strip out certain elements like the Jackpocket acquisition. Also, on the conference call, they had some very interesting data points. The number of unique customers on the platform is rising sequentially every single quarter, and that has been the case since Q3 2020. And also, online gaming was resilient in more mature jurisdictions globally across the global financial crisis. So you can see here that, generally speaking, when GDP decreased here in 2008, 2009, online gaming or gross gaming revenues actually continued to increase. So this could be a defensive trade to a degree. However, that was 2008 and DraftKings was rather small. We'll see what that looks like, when the company operates at scale and the macro deteriorates as it is right now. Nonetheless, a very interesting data point looking at the financials as a whole. And DraftKings financials are actually very simple. They don't provide convoluted financials like Amazon. Go look at Amazon's cash flow statement. It's very long and entrenched. DraftKings do the opposite. It's very succinct, very condensed. They don't try to hide anything, something you love to see in the financials. Now, revenue was up 19.9%, call it 20%. And you could see right here, cost of revenue, sales, product technology, and SG&A was an income loss of 46 million, but that is down about 66% from the 138 million loss in the same quarter last year. And that is why you have negative earnings per share of 7 cents, down 76% from the 30 cents loss in the same quarter last year. So the financials moving in the right direction, revenue growing, expenses falling. That is what you want to see. And you can see in the same quarter last year, sales and marketing only increased 3 million, right? Less than 1%. Cost of revenue increased roughly in line with revenue as a whole, but the company showing extreme cost discipline in sales and marketing as well as SG&A. And I think that is where you're going to see margins expand for this business. Looking at the revenue breakdown, sportsbook revenue was up 20%, iGaming revenue was up 14%, and then other revenue is up 45% for an overall increase of 20% in total revenue for the year. Now, if you are an investor in DraftKings, what you want to be watching is the consumer. That is the number one thing, and the macro slowdown. Okay. And then with regards to the business, you want to be looking at profitability. Can they turn the corner? Can net income be positive by the end of 2025? And where does that leave them with earnings per share? Looking 1 year out, 2 year out, 3 year out. And then I think the two major things you want to be watching is average revenue per monthly unique payer and then the monthly unique payer. As long as these are increasing 5% or more every single year, DraftKings is looking in a pole position. So I would say that the moat for DraftKings is narrow and unchanged, and the thesis is intact. The online iGaming and gambling will continue to improve, will continue to grow in the United States and globally, and DraftKings is in pole position to take advantage of that. But where does that leave us with valuation? Right now, on an EV to sales basis, DraftKings trades at 2.8 times, and on an EV to gross profit basis, it trades at 9.7 times. So actually pretty cheap in the grand scheme of things. However, the company does produce negative earnings, so you can't really compare it on an EV to EBITDA or EV to net income basis. Now, looking at our valuation framework, plugging in the trailing 12-month revenue of $5 billion, growing 17% to 2029, slightly under consensus, and assuming margins grow to 22% by 2029, producing $2.4 billion in EBITDA, and applying a 15 multiple, the current multiple is 43, right? You get the enterprise value, subtract the net debt, and divide by shares outstanding. I'm assuming that shares are going to decrease about 1% sequentially. They may increase in 2025, but then you should see buybacks ramp up significantly as free cash flow improves and as the company becomes more mature. And then you should get a stock price in 2029 of $74 on very conservative estimates. A 15 times EV to free cash flow multiple is below the market multiple of the S&P 500. The current stock price is $36, and that means you're looking at a 15.5% compounded annual growth rate on a very conservative estimates. I think that the EBITDA margin right here can probably trade closer to 25%. And I think revenue by 2029 can be very close to $12 billion if the company executes on all fronts. So this is very, very positive stuff if you ask me. I think that there's very positive developments in this business as a whole. And I would say that, yes, DraftKings is a buy right now. I mean, you have a 5-year time horizon. I think you'll do very, very well in this name. Looking at the charts and the technicals, you can see that this is a very, very clear spot of support. We used it as resistance multiple times right here. We broke above, then used it as support, and then we rallied to all-time highs on 2 separate occasions after using this line as support right here. We've pulled back based on Liberation Day and the tariffs. Every stock it pulled back. However, we found a bottom. We can call it here at the low 30s, and we are looking to retake the 200-day moving average. If we do go ahead and retake that, I would probably go ahead and target the $50 area, maybe even all-time highs towards the end of 2025, early 2026. So is DraftKings a buy? I would say yes. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.